Hi, this is Janae. This video will help you complete Module 5 Tax Planning. This is maybe one of the more complicated modules that we go through for some students, and so I wanted to help you understand how going through all of the content pages at the beginning of the module is really going to help you out as you complete the to apply assignments. So the first really important thing for you to do is going to be to open this introduction page so that you're probably familiar with these learning outcomes. It'll tell you to read chapter 5. That's going to be a really valuable resource for you in calculating taxes. There's some really great, so especially if you refer to page 74 in the chapter, it really breaks down how to do a tax calculation, which is going to come in handy to you. Also, there's this video right here of a professor who kind of walks you step by step through that process of calculating taxes. So I just wanted to point those both out because those are both going to come in really handy for this week's assignments. So the assignments due this week are kind of your traditional things that you've seen. So there's going to be a chapter 5 quiz. I would recommend watching this introduction video and then doing the chapter 5 quiz probably as the beginning step, and then getting into more of these other content pages as you're ready to do your apply assignments. For your apply assignments this week, you are going to be calculating the taxes of the family for your case study. So as you will see done in the textbook, in the video, and also you're going to get used to doing this on the chapter quizzes, you're going to calculate a tax flow using the information from your case study. And you're going to calculate it in two different ways. So if you read through this apply assignment, it talks about creating a table. So probably the way I would recommend doing this is doing it in Excel. Not all students are familiar with Excel, and so that's fine. You can just create a table in a Word document. But those of you who do know how to use Excel, you're probably going to find that really handy to do there. So you'll create a column that has the lists of the different parts of the tax flow. So a column that says gross income, adjustments to income, adjusted gross income, deductions. So you're going to have all of those things listed in kind of a title column. And then you're going to create the first column where you're going to go through those tax steps with the information from your family case study, but assuming that they don't own a home and aren't receiving any of the tax benefits from home ownership. So that's the first way that you're going to calculate their taxes. And the answer that you're going to get to at the end is, since we aren't going to have information about taxes withheld or taxes due, what I really want you to get to is annual tax liability. So you're going to get to this number right here. This part is important when you're calculating your own taxes and you've already had some money withheld. But we're just going to calculate their annual tax liability. And then you're going to go through that process again and add in some of the benefits that come from homeownership. So there are two major benefits that come from home ownership. One is a deduction you get for the amount of money that you have paid toward the interest on your mortgage. And then the second deduction you get is the property tax you pay on your home. So when you buy a home, it will hopefully reduce your tax liability. So you'll see that those come up, and then they refer back to some documents that came up earlier in the module. Calculate your home mortgage deduction and property tax. So we're going to look at those in just a second. I want to point out this content page that is understanding the home mortgage tax deduction. So tax deductions in general, and especially this home mortgage tax deduction, is something that a lot of people don't understand fully. They kind of have some concept of it, but how it's actually calculated, it's not really something they fully understand. This video from Khan Academy does such a great job of helping us understand how deductions in general work, and especially they apply it specifically to tax deductions. So I would recommend you read this page and watch this video to get the overall concept of how tax deductions work. Then specifically, this page is going to help you understand how to calculate the mortgage tax deduction for your case study. So the first thing that you need to do in order to calculate your mortgage tax deduction, you have to figure out how much the family paid in interest in the first year of owning their home. So that's the assumption we're going to make for this calculate your tax assignment, is that this is year one of the home purchase. So if you walk through this, will give you some steps to take of how, and hopefully this is kind of a skill that you've been developing from the other work that you've been doing on your financial calculator. But I have provided an example here for you so that you can understand how it will work. So what you need to do is to figure out, the first step is to set up your financial calculator as if you were solving for the monthly payment. So the example I'm using is a 30-year mortgage and a $200,000 home at a 4% interest rate. Yours won't necessarily be a 30-year mortgage with $200,000 at a 4% interest rate. You're going to use the information that you calculated previously on the Apply Credit Score and interest rate assignment. So you did a bunch of different scenarios with different interest rates, and you're going to pick the one that you think works best for this family. So just to make a note that all of these home calculations, you can either pick the dream home or the modest home. So whichever one you're probably starting to get a sense at this point which home might be the better choice for the family. So whichever one you feel like they're actually going to pick, go ahead and use that for calculating this mortgage deduction. And as far as the term and the interest rate and the down payment amount, so that's going to reduce whatever the present value of the home is. Whatever scenario you thought was going to be the best based on the assignment that you did last week, you use that scenario to do these calculations. So you set it up, so put in the amount that will be financed. So this is the price of the home minus any down payment. So you put what the loan amount is going to be on the, starting out on your mortgage. You leave payment blank. The future value is going to be going down to 0 over the course of paying off the loan. And then the number of periods will be 36. So it's 30 years at 12 months per year. So you have 36 months. And then your interest rate is going to be whatever interest rate you came up with from that last assignment divided by 12. But we're going to use a 4% interest rate in this example and get that into the right number for the type of calculator that you're using. So when you calculate this, you'll solve for payment, and you'll find that their monthly payment, so this is the principal and interest payment that services this mortgage, is $953.83 in this example. So that's great. So you have that set up. Now, in order to figure out how much interest they've paid in a year, you have to, so you leave that payment in there in your calculator, and now you're going to solve for future value after you change the number of periods to 12. So this is going to say, what does the principal of the loan go down to after 12 months of making that payment that you just calculated? So once you do that, you will find that after 1 year of making payments of $954.83, your loan amount will have gone down to, your principal amount owed will go down to $196,000, $477.93. So that is how much your principal has been reduced. So if you take the loan amount that you started with minus the amount that the principal balance is after 12 months of payments, you'll see that you have reduced the principal by $3,522.07. So that's kind of discouraging, thinking that you made 12 months of payments at $954. You paid a whole lot more money in to your mortgage than was actually reduced. And that's kind of disappointing, except so the kind of somewhat good part of that is that money doesn't 100% go to waste. It doesn't increase your net worth in any way, but the difference between what you paid in and what the balance was reduced to, that amount is what you paid in interest. So $11,454.96 minus $3,522 tells you how much you paid in interest, and you paid $7,935.89. So quite a bit of money to interest. This is typical in the first year of a 30-year mortgage. You're going to pay a lot more of your money is going to go to pay interest than it is to pay principal. But this is the amount that now becomes a tax deduction. So when you are calculating the tax deduction for your family, you can take this amount right here and add it to all of the list of other deductions. So, and there's one more tax deduction that you get to include. So if you go over here to property tax, so the amount of money that you pay in property tax also counts toward a deduction. You get the government says, thanks for paying your taxes on your property. We'll give you a little bit of a reduction on your federal income tax. So the best way to find this out is, so most home listings have an estimate of property tax. Not all of them do, but Realtor.com, if you look up your house that you're using for your case study on Realtor.com, and then you scroll all the way down to the bottom of the screen, you'll find this place that says payment calculator. This is super handy. I don't know if some of you have already been using it. It's just really handy. You can, has a lot of great features, but the one we're going to use here is the one where it estimates monthly property tax. So you take that monthly amount, times it by 12, and you will get your annual property tax. So that, both of those are going to help you on this apply assignment. So you'll add in the interest you paid on the first year of your mortgage and the amount you paid in property taxes. You'll get to add those to your list of deductions. And now you'll see if you add up all of the deductions that you have, including the ones you had before purchasing a house. Hopefully at this point they're going to be bigger than the standard deduction. If they are not bigger than the standard deduction, and you took the standard deduction also before you bought a house, then it turns out buying a house doesn't really help your taxes. But for some people, that will put them over that threshold, and they'll see a decrease to their tax liability because they bought a home. So that is what you're going to discover by doing the apply assignments. You're going to calculate that, and then you're going to go to the apply tax slides. You're going to go back to the budget slide that you created earlier, and you're going to put in the more accurate number for your tax liability. So you're going to take the tax liability that you found doing this assignment, and you're going to divide that by 12 and add it into your budget. And then you're going to create one slide that talks about what the family's tax liability is before buying a home, and then you're going to create a second slide that talks about the family's tax liability after purchasing a home, and then you're going to discuss whether or not that actually reduce the taxes for the family. You will notice there's a little bonus activity. If some people are tax experts already, and so they're